In this video, we are going to have a look at international taxation. So first and foremost then, tax is obviously developing, it's changing. And ultimately that has a lot to do with living in a digital world. We've already seen the rise of making tax digital. So tax in the digital world is the first thing we're going to have a little look at. So advancements in technology are making it much easier for companies to be able to trade internationally. They are able to do that more easier now than they've ever been able to do before. However, with it, it brings its own problems. So yes, it's a good thing. We're going paperless, it's more sustainable. However, it's going to bring issues with it. So in which country should a company exactly pay tax on profits earned? What happens when a company is taxed in multiple countries? These are all questions that need to be answered. So we are going to have a look at these in this video. Remember, tax regulators are always considering new ways in ensuring that tax is charged appropriately on income earned by companies within the digital economy. So corporate residence plays its part in this. So a company would usually pay taxation on its worldwide income in the country whereby it is a resident. So a company can be resident for tax purposes if either there is a country of incorporation or the country of control or central management. So this is something that companies need to consider. There may be advantages and disadvantages against both elements there. So if a company has dual resident status, it will generally be agreed with the countries involved that the company be treated as a resident solely in the country of central management for tax purposes. So corporate residence then questions the idea of how much profit is being generated from international trade. How many sales is a company making? Because remember, if profits are generated from sales to various countries, is it correct that the resulting profits are taxed based on the location of the company's head office? And of course, with that question in mind, many ethical dilemmas may crop up. Directors obviously are going to have to deal with those ethical issues, and they're going to have to come to some sort of agreement. So are they going to establish residence in areas to earn the most profits? Or are they going to seek residency in a low tax rate havens to mitigate tax liability? Both of which people may argue are unethical, but as a company, you want to be able to consider which is best for you and what is going to drive your business with the most profit. We then move on to the idea of double taxation. So this is obviously an issue if you are working amongst different countries. So sometimes profits may end up being taxed in more than one country. And a company may earn income in country one despite being a resident in country two. This is obviously going to rise if income taxed in the country where it was earned in the country where it was resident. It could occur where the company has a permanent establishment. And double taxation relief is available if there is a double tax treaty between the two countries. So we need to have an agreement here. So double taxation relief then. So this happens when a double tax treaty exists between two countries, essentially a mutual agreement between each one. Each treaty is going to be different, and it will depend upon the specific tax rules of each country. There's no two countries that are going to perhaps be exactly the same in terms of how they deal with tax in this situation. So what are the main ways then for double taxation relief? Well, the first is simply through exemption. So countries may agree on certain types of income which are just going to be exempt or partially exempt from tax in one country or the other. Second way of this is by tax credit. So tax paid in one country may be deducted as a credit from the tax due in the other country. Relief will normally be restricted to the lower of the two tax charges arising on any profits concerned. There is also the method of deduction as a final main way of doing this. So tax relief is going to be gained by deducting the foreign tax from the foreign income so that only the net amount will be subject to tax in the country of residence. Obviously, given the fact that we're dealing with this on an international scale, you need to be aware of the types of overseas operations. So a company which trades internationally may do so from its country of residence without any form of physical operation or process or presence in other countries. Alternatively, a company may set up an overseas operation, which can either be run as a branch or a subsidiary, which in some cases is a little bit easier. So a subsidiary then. Well, an overseas subsidiary is simply a separate entity for tax purposes. The parent company will only pay tax on income received from the subsidiary. So this is going to be things like interest and dividends as opposed to your profits. So subsidiary is liable for tax based on profits in relation to the tax rules in the country of residence. And loss relief may not be available for the group if the subsidiary is paying tax under different laws. Remember, a parent company is not usually subject to capital tax on gains made by the overseas subsidiary, and assets can be transferred to the parent, but this may result in a capital gains tax liability. Alternatively, a company may choose to set up a branch. So this will simply just be treated as an extension to an existing company's activities. This means that all profits will be subject to local taxation in the country of the company's residence, subject to double tax relief. Money that is transferred from overseas branches will not usually be treated as a dividend. And losses made by the overseas branch will likely be available for group relief. The existing company is usually subject to capital gains tax made by the overseas branch. And assets can be transferred between the branch and the existing company, and there will be no capital gain or capital loss made there. Types of foreign tax then. So we have withholding tax and we have an underlying tax. So we'll have a look at these in a little bit more detail in a minute. So withholding tax, what do we mean by that? So ultimately, this is the deduction of tax at source on payments such as interest, dividends, capital gains, and any royalties. Net income would be received by the beneficiary in the foreign country. That can be calculated as the gross payment less tax. On the other hand, an underlying tax is when a company will pay a dividend and it will do so out of post-tax profits. Profit would then be distributed as a dividend and it will have already been subjected to tax. Receiving a dividend from an overseas subsidiary means that the dividend is ultimately already taxed in the overseas country as part of the normal tax on profits calculation, but it will also be taxed again in the country of receipt as income on dividends. So there is a calculation to this, and it can be worked out by simply doing our tax on profits divided by our profit after tax and multiplying it by our gross dividend figure. So the OECD Model Tax Convention, what is it? Well, essentially it states that business profits of a company can be taxed in a country is a company with a permanent establishment in that country. So permanent establishment could include the following. So examples are factories, branches, offices, workshops. It could even be a place of management, a construction project, or a building site, provided you can argue that it is capital expenditure because it is taking over 12 months to actually complete. It could be a mine, oil or gas well, or a place of extraction of natural resources as well. So transfer pricing sort of links in here. So it's going to apply to any group situations when either goods are sold between companies at a favourable price or loans are made on favourable terms. It's going to result in transactions not taking place fairly, and company profits are ultimately going to be distorted. It may occur because the group want to avoid tax, and therefore they may attempt to move profits to another country whereby the tax rate isn't as high. So ultimately a form of tax avoidance. And companies may be criticised for not paying their fair share of tax for doing this. But there are some rules on transfer pricing. So there's goods and services where rules apply, and there's also the provision of loan finance. So for goods and services, the adjustment is going to be made in the corporate tax computation for the entity gaining the tax advantage to reflect profit that would have been achieved if the transaction had been reachable. In terms of provision of loan finance then, if the amount of the loan finance provided to a connected company exceeds the amount a third party would be willing to provide, the loan is no longer going to be reachable. Essentially, it is thin capitalisation. So those are the rules that you need to be aware of for international taxation.